Hello guys, welcome back to Investment Foundations. I'm Julian Vargas, and today we are going to see how to put all of our knowledge to assess our portfolio with information from the market and using Excel. We are going to use 3 different ETFs and we are going to see if you learned something so far. So let's start. So first we are going to download the information. I like this website investing.com because I can download everything from here. So I'm gonna go here to markets, then to ETF, and then I'm just gonna select one of those ETFs, which is are the major ETFs. So let's see here. After having this, we check here that we have all the data, and then we click here download data, so we can have our data in CSV format. Another website that I really like is Just ETF, especially in Europe. This is really useful. You can see here all the asset classes and all the ETFs that you can have per asset class. So I can also come here to the search bar and I'm going to search for S&P 500 and I'm going to select this one from iShares. What is good about this one is that if you come here down, you will see a list of brokers in which you can actually make this transaction with this ETF. So make sure that you are somehow within one of these brokers. So coming back from our data, we have already downloaded the first series. So what I'm gonna do here is I'm gonna copy and paste the returns, which is the last column of that file, in my Excel sheet. Before starting the whole analysis, we are going to download 2 more ETFs. We are going to select here this high yield corporate bond to represent this other important asset class of bonds. Same procedure here. I'm going to historical data. I select here a monthly basis and go back to get 5 years of this history. Finally, I'm gonna select also here a gold ETF to see, that's really cool to see the correlations of stocks, bonds, and certain commodities. In this case, let's select this one that is called DB Physical Gold Euro. Same procedure here, so let's speed it up a little. So now let's paste all this information from these other 2 ETFs into Excel. So the first calculation that we want to make here is to estimate the return of each of these ETFs or of each asset. Remember from previous videos that we learned that for returns we will calculate the geometric average. So let's try that here. Oops, but here we got an error. What happened? Do you know the answer now? If you know about geometric average, you know that in order to use it for our investments, we have to add a +1 for each of the returns. So we are going to do it here in another 3 columns. So we copy and paste, so we have everything expressed in 1 plus the return. And now let's try what happened if instead of that column I select this one. Oh, look at that, we got a number. However, we have to subtract a 1 in order to get our information in a return format. Now remember what I have been telling you, like just calculating the return bring us nothing. So we need to start calculating the risk. And for that, let's start calculating our variance for one of these investments. We will use here the formula VAR. Now we have the variances of each of the investments. We are going to build first the correlation matrix. For that, let's take here our investments and paste them here in a transposed base. So we are going to put here in the diagonal the correlations, which is with each of the investment, which will be equal to 1, and outside the diagonal we will put the correlations. So as I said, we know that the diagonal has a 1 vector, and then we will calculate the correlations using our formula correl from correlation. Since my keyboard is in German, it's going to be a bit different, but if your formulas and Excel are in English, you will find the formula just by tipping correl. So don't forget that we have to choose our series here in order to calculate the correlation between the assets that we want to have in our matrix. Finally, we know that this matrix is symmetrical over the diagonal, so we can just basically here put the same correlations that we calculated for the upper part of the matrix and put them here down. It is important that we have our matrix completely filled, right? Because we are going to use that matrix in the calculation of the risk of the portfolio. So the correlations are a really good indication to see how our investments interact with each other. In this case, we see that, for instance, the S&P 500 with gold has a correlation of 13%, which means that they are not really high correlated. And that's what we are looking in our investments, that the correlation among them is not as high. Here, S&P 500 and this particularly ETF bond seems to have a high correlation, so it's not ideal. So with this, we are going to have like a first explanation and understanding of how our investments are interacting. We are going to calculate the covariance matrix as well, because this one is going to be much easier to calculate the risk of our portfolio in the end. We can also use the correlation matrix. I personally prefer to use the covariance matrix because the formula after that is going to be easier for our total risk calculation. So same procedure here. Let's build first here the column so we know what we are calculating. Remember, the diagonal of the covariance matrix is going to be the variances of each of our investments. We can also use the covariance function, but it will be with itself. So what I'm gonna do here is first going to calculate this covariance, but I know that this is between S&P 500 and the corporate bond, so I'm gonna move it here. After this, as I was saying, we just simply put here the variances which we calculated before, and let's finish by putting here the covariance of the S&P 500 and gold, and also from the corporate bond and gold. So now we have all the information that we need to finally estimate our portfolio return. So let's write that here down. And we can simply use here the formula sum product in order to just get the vector of the geometric average that we calculated before and the other vector of the weight. What this function is going to do is just to multiply one by one and then add the map. So we are going to have here a total portfolio return of 0.45%. This number seems to be a little bit too low for a return in investments, but remember that we have our investment, our databases is by month. So that's why this return is monthly. So we have 0.45% monthly, and we want to calculate what would be that return on a year basis. So we just simply multiply that result by 12 and we get 5.38%. So now it's time to calculate the risk of our portfolio. For that, remember that we are going to use the vector with the name WT, which is going to be the portfolio weights transposed. So we can just copy and paste them here. Now we have all the information that we need to calculate the variance of our portfolio. If you remember the formula from our previous video, we will see that the formula will be W, which will be the vector of our weights, multiplied by the covariance matrix and then after that multiply back again with the transposed vector of that. So here we have the formula. So how we use that formula, since we are multiplying vectors and matrices here, so we will use the formula mmult. I also explained that in a previous lesson. So putting here the right arguments, first are the portfolio weights, after that the covariance matrix, and then the transposed vector, we come to this result. This will be the variance of the portfolio. And for us, in order to understand it a little bit better, we need to calculate the standard deviation, which is the square root of that number. So with that, we know now that our standard deviation is 4.01%. Here we have the same case as with the returns. Since we have the information on a monthly basis, the result that I am getting here for the standard deviation is also monthly. So to put the standard deviation on a yearly basis, we are not just simply multiply that by 12, because that is not how variances work, but we are going to multiply it by the square root of 12. This is going to give us a result of 13.88%, which now we can compare and say that is year by year. Now I want to have everything here linked, because I want to show you what happened if we can play a little bit with the portfolio weights and what happened if the distribution of my portfolio is different. So let me correct here, and instead this WT, I'm not gonna put it just as a copy paste, because that would be really hard if every time that I change something. So I'm going to formulate here using this formula mtrans, which stands for transposed. So here I have to select the 3 cells, then I put the formula, and in the end don't forget to just not put the return key, but Ctrl+Shift+Return. Let's take a look here at our investments. So we can see here that the S&P 500 has the higher geometric average or expected return, or monthly expected return, which would be like 0.77. So we can also analyze what happened with the risk of all of these investments. We are going to measure risk as the standard deviation of the returns of the last 5 years. As we can see here, the S&P 500 also has the highest risk. So I encourage you here to start playing with these weights to see what happened. First, let's formulate our last weight, so we know what we need to have, like 100% in our portfolio. So I'm just gonna put here that the investment, or the amount of the investment in our third one, will be 1 minus the sum of the other two. So we'll see if I put first here that I want to have like 40% in S&P 500, which is going to be higher, and we'll get a higher return, but also a higher risk. However, if I change my percentage to 10% on the S&P 500, I will get the contrary, of course. So less return and less risk, as expected. And there you have it. Now you know how to calculate the expected return of a portfolio, where to download the data. Just take in mind that you need to download the data of investments that you can actually put into practice in your own country, depending where you are. And don't forget to measure the risk. And I hope that you like, and now you use this information to calculate the value of your portfolio. So if you like it and you want to see more, just subscribe, hit the like, and see you in the next video.